Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And today, I wanted to talk about taking a potentially more aggressive approach, pursuing higher turnover income by selling weekly call options against existing stock positions. There are some traders that are attracted to exactly this sort of a strategy. So I wanted to talk about 4 possible motivations or pros for doing this sort of an approach to covered calls. But then we're going to talk about 4 potential cons. So you got to look at the other side of the coin when selling weekly options. So I think this is going to be an interesting discussion. 8 important considerations when selling weekly options for call income. So really should be a great discussion. We'll place an example trade at the end. Before we can get to any of that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube, all my familiar names. Hello there, Mighty Mouse and Kevin. Actually, a pair of Kevins out there. Yena, Will, Noodlebrains, Greg, Alfie, Jack, JDLMI, Pro Caddy, Paul, Bush, Kboja, and everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you're here for the very first time, and there were a couple of those screen names that I wasn't entirely familiar with, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, watch those recordings. That's a great way to view these webcasts, but you're certainly invited to join us in a live discussion. If you'd like to be here, this is a Monday webcast series. We kick things off promptly 2 Eastern time. Now, as a special treat, my very good longtime friend, Ben Watson, is hanging out in the chats with us. Ben's already been here for 20 minutes, keeping an eye on the chats. Ben's going to be watching for any questions that come in. If I can't get to those, he's there to pick up my slack for me. Thanks for having my back there, Ben. And Ben and I would also like to issue an invitation to everybody listening to follow us on social media. You can find Ben and me on X. You can follow Ben there at Ben Watson CS. You can find me on X at Cameron May CS. You can also now follow both of us on LinkedIn. Just go to linkedin.com/in, throw on another /, and then for Ben, it's Ben Watson CS. For me, it's Cameron May CS. That'll take you to our profiles, and you give us a follow there. But let's get right into this discussion of selling weekly covered calls for income. And as we do, of course, this approach, along with every other approach to trading and investing, carries risk. So bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set an agenda for today's discussion. So, as always, since this webcast is part of an ongoing series of videos or webcasts, we have some example trades already in place. So we're going to take a look at those. We have 7 in our example paper money portfolio. I don't think we're going to be making any changes to those 7, so we should be able to get through those fairly quickly. Then we're going to take a quick look at what's going on with the markets to sort of set the stage, give a little context for a trader who might be looking at selling weekly options. And then we're going to get into this discussion of the pros and the cons of selling weekly covered calls for income. What are the primary motivations? What are some of the primary potential drawbacks? And we're going to frame that all within a current example trade. We'll place that trade at the end of the discussion. So let's go right to the Thinkorswim desktop. Here's the simulated trading. This is the paper money platform. Here are our 7 current positions. And you can see if we look at our profit and loss column, everything's going pretty well. This Microsoft put needs to do a little bit of work, but it's still way, way out of the money. Plenty of time to leave that one to work. But we did a trade on Apple last week, sold a put. With this trade, it's a 265 put expiring in 18 days, so we prefer for the stock to be above 265, and right now it's at 273, 74-ish. So here's what's going on with Apple. Sold the 16th of January, 265 puts represented by this red line. So we'd like to just be above that red line if the objective of the trader is to see this expire worthless. And here's the expiration date, January 16th. So that's where price is right now. Now, if we happen to get assigned, we do have a backup strategy, and that is we'll consider selling covered calls if assigned, if the stock doesn't appear to be in full collapse mode. Now, we've already previously sold puts on this stock before, That was for the December 19th expiration, and those expired already for a 277 profit. So we're looking to stack up maybe a second profit here. We'll see. Seems to be working. It's about halfway, not quite halfway to that maximum gain. Our AbbVie position is a covered call. Bought shares, sold the 240 calls. So here the preference would be for the stock to go up above our trade price of 227.18, but to maybe stay below 240 if the trader doesn't want their shares assigned. That would give the strongest likelihood of that scenario. And right now you can see the market price is above our purchase price for our stock, below the 240 strike for the calls. Profitable overall on this trade, $917. Let's go see what that looks like on a chart. So here's where we purchased those shares. Our break even is down here. Stock is above the break even, working its way toward the expiration, still solidly below our 240 strike price. Now we were going to consider selling out of this position, closing this covered call position if support broke. We never got down to that 220 level. We're coming up off of that. So that looks okay. We're going to let that one continue to work. Next up, we have our Amazon position, another short put, the 215 strike. In this case, if the trader is looking to just see this expire worthless, they're looking for the stock to be above 215 as we move toward the 16th of January expiration. And right now it's at 231. So we sold these contracts for $3.70. A trader might look at this and those contracts are now only worth 66-ish cents. We might be able to close this thing out for a $3 profit and just take that risk right off the table. What do you think? Let's go have a look at what's going on with Amazon. So here's our strike down here. You can see how we've been moving toward expiration. We're about halfway there, but we're more like 80% of the way to our maximum gain. Break even's down at 211.30. We were thinking about selling covered calls if assigned. Assignment is looking less and less likely at this point. But what do you think? Trader might decide to just hang on, see if we can get the other 66 cents by expiration. You know what? We have two contracts. I wasn't really planning to do this or make any changes, but just to show that this is a possibility, how about we close out of one of these? See if we can bank somewhere on the order of a $3 gain on this. So I'm going to right click. Let's create a closing order to buy back not two of these contracts. Let's just do one of these contracts. And it looks like it might cost us around 67 cents. I'm going to dial this up. Let's say we're willing to spend up to 70 cents since we sold it for $3.70. If we're able to buy back for 70 cents or less, that would leave us with that $3 per share gain of 300 bucks, banked profit, setting commissions aside. But let's click confirm and send. We're offering to buy back that 16th of January 215 put for 70 cents. So we're leaving one working, looking to exit one. There would be a commission that would increase the cost to buy back from $70 to $70.65. Let's send that off and see if we can fill that. Yep, and there we go. Bought out for the 67 cents, so there's a realized 303. John is saying, hey, maybe hold on to these until they're worth 33 cents. In other words, about 10% of what they originally sold for. So in this case, we have one left. We'll see how it goes. But that one is now a realized gain. If we go to our chart, what we might want to do here is let's make a little oval around today, just to signify that something happened here. And I'm going to make a note here. Closed one contract for $303 profit. Should we just say a 303 profit? That'll work. There we go. All right, so that leaves us with the one remaining. Okay, so that was a little bit of an executive last moment decision just to illustrate what might be done. Now, obviously, the con of what we just did is we did leave $67 on the table with a high probability of success. That thing is well out of the money. If it's still out of the money as we go to expiration, there was a strong likelihood that we just wasted 67 bucks. But in the meantime, we no longer have the obligation associated with that put. So there are trade-offs there. Let's have a look at our Alphabet position. Bought 100 shares at 199 a long time ago. Sold some calls at 325. So we'd prefer for the stock to just keep going higher, but to stay below 325 unless we don't mind getting assigned. But let's go have a look at that position. So we sold those shares or bought those shares way back here. Recently sold a 19th of December 315 call. That expired for a 277 profit. And then again sold a 16th of January 325 call for 290. And you can see the stock has still been going up, still behaving bullishly. That's helping out our shares, but we're still below that 290 strike, so less likely to be assigned. We're working our way toward expiration. Break-even is way, way, way down here. If we get assigned, okay, we sold our shares for 325 that we previously purchased for 199, and we have about a $126 realized gain there, but that's hypothetical at this point. That's Google. Our Microsoft position, we sold a put. This is a long-term put, doesn't expire for 753 days. There are people that do exactly this sort of a strategy where they sell long-term puts with the objective, positioning those way out of the money. And hopefully, if we can just get a rally sometime between the time we sell that put and expiration, in this case, we've given ourselves a couple of years to do that, a single rally at some point may allow us to close this put out for significantly less money. That's actually not what has happened here. So far, we saw this drop, and then we've kind of chopped sideways right around this previous support level. Looks like that's kind of being a ceiling at the moment. We'll keep an eye on that. If this starts to fall, that's not what we want. But right now, it's just a little bit underwater. Sold the contracts for 23. They're worth 25 on the nose as I speak. That's interesting. So yeah, so 200 bucks. We'll let that one continue to work. Our NVIDIA position is a covered call. Bought the shares for 183. Those have gone up in price. Sold the 195 call for 193. That's also gone up in price, but we're not in the money yet. Still at 187. Overall, this trade is profitable. So here's the NVIDIA position on our chart. So we sold that 195 call. You can see we recently got pretty close to that strike, still out of the money, and we've pulled back a little bit today. We've already closed out 2 previous call trades for profits. So we've been lowering our break-even point, closed out the December calls for a 343 profit, the November calls expired, or call, I should say, expired for a 340 profit. So we already have $6.83 of realized gain. This has added almost another $2 of potential gain. We're not gaining on that yet, but the stock is still where we'd like it to be. And so we could actually add $683 to the $263 that we have in unrealized gains right now. And actually overall, we've made about $900 on this trade so far. So finally, we have our ExxonMobil trade. So bought the shares at 116 and change. They're worth 120 and change, up about 400 bucks on the shares. And we sold a call for 220. It's worth a little bit more, but we're still below our, no, actually slightly in the money. Sold the 120 call. If we're looking to not get assigned, we'd like the stock to be below 120. It's actually slightly above 120, but even if we do get assigned, that would become a realized gain of $3.19 on the stock. In addition to, if we were assigned, that would mean our call would become a realized gain. So we're in good position. We're theoretically right now, if we were to stay right where we are, we'd be at maximum theoretical gain at expiration. Is that a negative outcome? No. Is it the optimal outcome? Not always. If the stock were to rally sharply above 120, we'd have to sell the shares for 120. And we might be leaving some money on the table in the form of capital appreciation. But so far, so good with those trades. We'll just leave those working. I wanted to do a quick recap of those. But now let's have a look at what's going on with the markets. I think without even looking, if we can just look at a bullish portfolio like this and notice that almost everything is working, that tells us a lot about what's going on with the markets. Markets are probably bullish themselves, and they are. Yeah, if we look at the S&P 500, we just set record high closes. We're down a little bit, 0.5%. off of record high closes. So just a continuation really of this extremely strong rally. And I say extremely strong, obviously that's a bit of a judgment call, but I don't think that's pushing the envelope of anything, recognizing how sharply the markets have recovered since the first week in April. So let's just say, let's put ourselves in the shoes of a trader who's out there for income and they're looking for either selling puts or selling covered calls. Somebody just asked, do you trade Chinese stock? We don't talk about that in this webcast, and no, we don't do any examples of foreign trading. So it's not to express a personal preference. I don't offer personal preferences in these webcasts. I talk about the pros and cons of different strategies, walk through how they might work and how they might fail, and we do examples. So good question. But the answer is no, you won't see any of those in these webcasts. All right, in any case, let's go look at an example weekly covered call. And here's the setup that I chose. So when trading options, a set of priorities for a lot of investors out there might be, well, how much does the stock cost? Because that has strong implications regarding the rights or the obligations associated with the contracts we're trading. How liquid is the stock? Because illiquid stocks tend to have illiquid options and they can be harder to trade profitably. And what's going on with the chart of the stock? Now, not every trader sees stocks with those three lenses, but those were pre-qualifiers for the example that I selected today. So I looked for a highly liquid stock, I checked the price per share, and I also looked to see what was going on with the chart, and I wanted to look at Visa today. So here's what's going on with Visa, one of the biggest companies in the world, one of the most liquid stocks out there. Its options are also among those that are most heavily traded, so they will tend to have pretty narrow spreads between the bid price and the ask price on those contracts. But let's say that we have a trader who's out there looking for income, and maybe what they're tinkering with is the idea of selling shorter term contracts. All right, well, what's a technical scenario that might motivate doing a covered call in any case, regardless of the time frame? Well, for some traders, what they might look for is a stock that seems to be going up because covered call requires stock ownership, but maybe appears to be at a price ceiling. It's at those moments when a trader thinks that the stock might peel back a little bit, that they might consider adding some income. If appreciation doesn't seem to be on the menu for a short period of time, maybe income can be on the menu. Now, there are pros and cons to that. I want to talk through that. But that's sort of the logic of this trade. Here's a stock that's been rallying, but it looks like it has an immediate obstacle to overcome, and that appears to be a resistance level that has held. We really haven't seen a close above $357.50 since this big drop back in June. So it's been more than 6 months. So maybe our trader thinks we're going to bump our head and peel back a little bit, and maybe that opens a little bit of a window of opportunity for selling calls for income. And what I want to do here is demonstrate keeping that window as small as possible. So let's talk about some of the motivations for doing weekly contracts. For our example trade today is actually going to be, this is going to be a spoiler alert, let's look at contracts with just a few days left. Those literally might be trading in the pennies. They might not be worth it for some traders. I'm going to look at the 9th of January. These are still weekly contracts, only 11 days on these contracts. And the one that we're going to consider for this example is with resistance right here at about 357.5. How about our trader decides to sell the 357.5 call? So here's our example trade. It's going to be weekly covered calls. And so in this case, we're going to put ourselves in the shoes of a trader who is right now buying 100 shares. And it looks like we may have to pay around $354. Let's call it $354.15. Obviously, price is going to change as we're speaking. But at the same time, to create the covered call, we're going to sell on 9th of January, 357.5 call. And that looks like that's trading for around 184 to 206. Let's kind of split the difference there. Let's say we're able to get that for 195. Okay, we sell that for 195. Somewhere in the middle. It's obviously not guaranteed. These are just estimates for what we might pay and what we might receive if and until our order fills. Okay, so what are some of the pros of this sort of an approach? Why are some traders so attracted to strategies of selling covered calls for just weekly expirations? They expire so quickly. Well, number one is really has to do with the primary motivation of selling covered calls in the first place, and that is collecting income as quickly as possible. Okay, Noodlebrain says, can you buy a leap instead of if you can't afford 100 shares? Theoretically, we could. That's a strategy sometimes referred to as the poor man's covered call. Yes, I realize there's sort of a gender-specific reference in the title. It's not my title. I'm sorry. But yeah, that's what it's frequently referred to as. We might just call it the poor trader's covered call. What do they mean by poor? Well, instead of buying the stock and selling calls against it, maybe they look at buying the right to buy the stock and then selling calls against that, a long-term call option. Now, this webcast is not called Trading Diagonal Spreads. I actually have a webcast where I do that, webcast series. That's what that is. So I'm not going to go too far off into that approach, but let me show you something on YouTube. So if you are new to these webcast series, here's what I would suggest you do. Come down to the bottom, click on subscribe. Look right down below the video stream. Click on the subscribe button. That'll subscribe you to our YouTube channel. But this is where our YouTube channel is called Trader Talks Schwab Coaching Webcasts. That's where you can join our live streams, but you can also find playlists of previous webcasts, or you can do a quick search for topics of interest. So going back to Noodlebrain's question there, referring to this strategy known as the poor man's covered call, I wonder if I just type in poor covered and just hit enter. What do we get here? Hey, what's a poor man's covered call? There's a webcast that Brent has done previously on the topic. And here's one right here. Why do some traders call this strategy the poor man's covered call? You might want to check that out. All right, great question. But back to our discussion here. What are some of the pros? I'm going to rattle these off. So number one, theta. Number two, more frequent income. I'm going to call this potential because income is not guaranteed in this strategy. There may be greater flexibility with this strategy and shorter term obligations. So let's talk through these just one at a time. What do I mean by theta? Well, theta is the time decay element of selling an option. Time decay, as we know, has an impact on the value of options. And typically, what a trader is looking for when they're selling a covered call is they hope that time goes by quickly because they're in a contract where somebody might buy their shares from them. They're just waiting for that contract to expire so they can keep the premium collected and maybe get on to selling another covered call. Well, that time decay element is actually literally at a premium when selling short-term call options. And we can gauge that. If we look at the theta column for this contract that we're considering, you notice it says minus 15. It's because over the next 24 hours, the value of this contract, if everything else hold constant, if the stock doesn't move, if volatility levels don't change, the value of this contract will drop by about 15 bucks, 15 cents per share on 100 shares, about $15. So that's actually working $15 in the favor of our covered call trader. So this is, I just always think of theta starts with T and so does time. It's the exposure of a contract to the passage of time. And in this case, that's a positive exposure to our covered call seller. Now, if we were to compare that in an exaggerated way, let's say we went out and instead of selling an 11-day contract, what if we were to sell close to an 1,100-day contract out there on the 15th of December of 2028, and we look at, I don't know if we'll get the same strike, but we'll have a similar strike. So instead of selling maybe the 357.5, let's look at the 360. What is its theta exposure? Only $4. Over the next 24 hours, a trader who sold this contract might get $4 worth of time decay. A trader selling the much shorter term contract gets $15 worth of time decay in unrealized gains, progress toward expiration. So theta, big element of why some traders like to sell these short-term options. Number two, there's the opportunity for more frequent income potential. This contract, whether it works or not, is going to be over in 11 days. And once it's done, the trader might turn right around and go for another 5-day, 7-day, 11-day weekly contract. So there's an enhancement of the potential for more opportunities. And maybe that allows some additional flexibility in the form of diversification and also avoiding unwanted risk exposure. So here's what I'm talking about there. So Eva, you asked the question, traders in a hurry for premium money, why else do weekly? Okay, yep. So these are the 4 reasons. Now, I don't want to say these are the like all caps, the carved in stone 4 reasons that some traders are motivated to do this. I just thought these are the ones that, at least to my mind, it's bring top of mind as motivators for selling weekly contracts. Faster time decay on a per day basis, higher potential returns. That's the concept there. More frequent opportunities, greater flexibility means these sorts of strategies can be tailored to sort of fit into narrow windows of opportunity with, let's say, a trader thinks that a stock is only going to pull down for a few days, or maybe there's an earnings announcement on the horizon. Maybe what they prefer is to do a lot of covered calls over the course of a year and thereby sort of introduce a different element of diversification in their portfolio. But yes, this sort of approach, because of its short-term nature, can add some flexibility scenarios to the trade. Now, finally, there's just the fact that the obligation lasts for a shorter period. And if we're to go back to our exaggerated extremes here, if we sell this $357.50 call, that means for the next 11 days, someone has the right to buy shares from us for $357.50. Now, actually, in this case, that would be a few dollars more than we theoretically paid for the shares. So it wouldn't necessarily be an unprofitable outcome, but it shrinks the window of opportunity where we might be dramatically wrong with the timing of the trade. Giving a stock 11 days to do something dramatic, that means it's not as likely to happen as this example. Let's look at this. What if we did this 15th of December 2028, almost 1,100-day contract? If we were to sell that 360 call, well, for the next 1,100 days, do the math on that, more than 3 years, it's actually right on 3 years, right? Someone shouldn't say more than, it's just about exactly 3 years. Someone will have the right to buy shares from us for $360. So if the shares go blasting off, how high could they go in 1,100 days? Could those shares go to $400, $500, $600, $1,000? They theoretically could. Give them 11 days, they're probably not going to. Give it 1,100 days, all of a sudden, the world of possibility starts to open up, and the world of disappointment starts to open up. So yeah, the shorter obligations, I'm using an extreme example to sort of highlight this, but shorter term obligations can reduce the likelihood of dramatic disappointment. It also means we're only holding shares for 11 days. So if the shares fall in value, it reduces the likelihood that we have an event where we see dramatic collapse in that investment value. Eva, you looking forward to the cons? Okay, well, that was the fun part. That sounds like a sales pitch for this strategy. It's not. Nope, I'm not promoting a strategy. I like to just explain why some traders will tend to favor a strategy, but they also need to be aware of the other side of the coin. What are the potential cons for this strategy? Let's rattle these off. And this is, again, is not an exhaustive list, but maybe top of mind things for traders considering these strategies. Smaller premiums. I wish somebody paid me $10 for this trade. They're not going to. Right now, we're looking at about $2. If you look at the longer term contracts, a trade-off here is you're getting a much larger premium. This one's exaggerated again, but it's still there. It's on offer. What's a second potential con? There is increased assignment risk. And at the same time, an increased possibility of what we call a whipsaw event. So what is this? Well, we're starting off the trade right close to expiration, and one of the variables that can increase the likelihood of assignment is getting closer to expiration. And really, with this trade that we're considering, it wouldn't take much of a bump for the stock price to get above 357.5. And then there's not much time left for it to reverse course if the trader doesn't want to get assigned. So yeah, we definitely have an increase in assignment risk. So for a trader who doesn't want to sell their shares, this may not be the strategy for them. Now, obviously, if we absolutely don't want to sell our shares, covered calls might not be the strategy regardless of the amount of time, because you never know when somebody's going to get a wild hair and assign early. All right, number 3, there is less room for error. Same logic here. If the stock moves in an unanticipated way, there's just a narrow window for the stock to reverse or correct course, is what I might say. Less room for error. The timing for the trader who doesn't want to get assigned might need to be more precise. And finally, number 4, it requires more time. More time, more management required. By the way, even the bookkeeping, if we're selling into and out of positions, let's say every week, that starts to stack up the number of transactions. It can multiply the number of commissions. It can increase the bookkeeping at the end of the year, all kinds of things. But yeah, if we're selling covered calls on a regular basis for short periods of time, that means we're keeping a closer eye on new developments on those, since we have narrow windows. And when the trade's over, if the trader wants to get back into something else, well, that responsibility comes around much more rapidly. So is this an absolutely flawless approach to trading for income? Absolutely not. Does risk exist? It certainly does. Are there potential pros to this approach? Yes. Are there potential cons to this approach? Absolutely. But let's implement this approach, and let's just allow the individual investor, as we're contemplating this paper trade, decide for themselves, does this seem to be the kind of strategy that might apply to my portfolio? Always weigh the pros and the cons in making that decision. Looks like right now we might be able to bump this up a little bit. Might be able to get, instead of $1.95, might be able to pull in about $2.10. And that's because the price has gone up from $3.54 and 15 cents. It's now about $3.54.64. Let's round that off to 65, just for round numbers' sake. We don't know how much this is going to fill for, but let's go place this trade. And as we do, I want to put in an order to try to manage the downside of the trade, just in case in the next 11 days the stock starts to stumble. So I'm going to right-click on the ask price here, and let's put in a buy order for what Thinkorswim calls a covered stock. That's a covered call. And we're going to do, now if we did 10 of these contracts and 1,000 shares, that would be, yes, $354,000 trade. Let's dial this down. Let's just do one contract, and net between paying $354.5 or so for the shares and collecting around $2 on the contracts brings the net cost of this trade to about $352.5. Let's say we're willing to spend $352.5 on the nose, $352.50 to get into this trade. I don't know. We'll see if we can get this filled. Well, it's possible. Let's look at our chart. It's possible the trade might bump its head right up here and pull back. Well, that might be okay. This might be just what this covered call trader is looking for the contract to just expire worthless. But probably what they're also hoping doesn't happen is a collapse in value of the stock, because we own 100 shares. And if those 100 shares start screaming downward, we're the ones that are taking those lumps. So let's say that our trader thinks that at least our trend is still intact as long as we stay above that recent low. So if we don't fall below that, maybe we're okay just riding out volatility. Maybe that allows the call to expire worthless, and we go on selling another call next week. However, if we fall down here below 343, should we give it down to 340? If this falls to 340, let's say that our trader at that point is quite convinced maybe holding shares and collecting even weekly income might not be worth it. So I'm going to put in a stop on this to get out of the entire position, the stock and the call at the same time, if we fall to or below 340 bucks. Here's how that might be done. I don't know if you were aware that you could do this. I'm going to change our order type from just a single order, just to get us into this covered call, change that to a first trigger sequential order. In other words, our first order to get into the covered call, if it fills, a sequential order to get us out of the covered call will go into effect. All right, here's that sequential order. I'm going to right click on this now and create an opposite order. This is to close out the position, sell the shares that we bought, buy the contract that we sold, close it out, the whole thing. But not right now. Maybe we're looking to see this happen if the stock falls down to $340. So our condition for this is for Visa, the market price of Visa, to fall to less than or equal to 340. That's down below that recent low. Maybe the trend is under threat at that point. That might be the trader's conviction. Well, so if we fall below 340, what do we want to have happen? Well, we want to sell our covered call. The thing is, we don't know how much we might be able to net get out of that at that point. We're not going to get 352 bucks out of it because the shares would only be worth 340 or around there. And it would cost us some to buy out of that call, maybe only pennies on the dollar. But let's change this to a market order, good till canceled. So explicitly here, we're saying if the market value of Visa drops below 340, if it falls to or below 340, that will trigger a market sell order to get us out of this covered call. Okay, so we're going to save that order and click confirm and send. Buying the one covered call, 357.50 call is what we're selling. Trying to get in for a net of 352.5. We have an exit order to close out that covered call if Visa falls below 340. Now this is a form of a stop and it's not guaranteed. We don't know how much we will sell for. We don't know what the net credit would be to the portfolio. It probably would be a little bit less than 340 bucks unless the stock is really gapping down, in which case it might be a lot less than 340. But there's a little reminder here. Please note that you've selected a weekly, hey, what do you know? That was the point of today's discussion, a weekly option series with a non-standard expiration. Yep. And there are commissions to be paid to get into the call contract and potentially to get back out. So let's send that order off. And okay, we offered to get in for at least for a maximum of 352.5, and it cost us 352.41. So we can look at our filled orders, and we bought the stock for 354.54, sold the call for 213. If we get assigned, we'll wind up selling the shares for about a $3.20 profit, in addition to our $2.13 that have already been collected in our premium. So really for this trade net, we can make a little bit more than $5 in this week. $5 in a week on a 320 something or 350 something trade. For some traders, that's sufficient weekly potential. It's not a week, it's actually 11 days, but sufficient potential profit there. Shane says, are these new topics? They feel like new topics, so I'm not sure. Was that referring to something else there, Shane's? Dr. Tony says, will the closing order expire when the option expires? Yes, it will. Yep. Good question. All right. Guys, we have accomplished what I set out to do today. I wanted to talk through the pros and the cons of pursuing income by selling weekly options contracts. Yes, there are some potential theoretical advantages, but there are also certainly some potential risks associated with this approach. So I wanted to talk through those, give an example trade. I hope this was helpful for you. This is what we do with our Mondays. So if you enjoyed this, make sure you put it in your personal calendar to join us each Monday in the live session, or of course you can also watch the webcast. So I'm going to let you go enjoy the rest of your day, but before you do, let me make you aware of the full slate of educational resources available to you from Schwab Education, starting with our YouTube channel. Yeah, if you're new to this and you haven't subscribed to our YouTube channel yet, make sure you do that. You can just click on the subscribe button right now. It doesn't cost anything. It only takes a second to do that. But our Trader Talks Schwab Coaching Webcast YouTube channel is where you can join our live streams, or you can find the playlists of previous webcasts. You can also do searches for keyword items of specific interest. It'll search through our archives just like I did a little bit earlier today. But let me just show you on the playlists. If I click there and I scroll down, sort of down toward the middle, you'll see my trading covered calls and short puts. There's the full playlist of videos and webcasts that we've made for this series. And you can go all the way back through these. Just check out last week's discussion and trade and so on. Now, another thing that Ben and I definitely want you to be aware of is you can follow us on social media. You can follow Ben and me on X or on LinkedIn or on both, and neither one of those costs you any money to follow us. So, first of all, you can find Ben on X at Ben Watson CS. You can find me on X at Cameron May CS. And if you reply to me, or reply to one of my posts on either of my social media platforms, I just try to reply right back to you. Sometimes there can be a little bit of a delay. Don't be surprised if there's a day or two or three. Sometimes things get busy, but I'll still go back and look at all my recent posts and answer any question or answer any post that is appropriate. So do keep it appropriate. Sometimes somebody can get off in the weeds, politics or something like that. I'm not going to touch it. But another thing is that you can follow Ben and me on LinkedIn now. We've only been on LinkedIn for less than 2 months, Ben. So we're still gathering up those initial followers. So follow us here on LinkedIn as well. A nice advantage for us is that we can make longer posts. So that's kind of nifty. Here I just threw on a reminder last week that, yes, we are back to normal hours on Friday. But if you reply to my posts here, I try to reply right back to you. Like here's another example of just a longer post. This is nice. This was just the Paramount potential acquisition of Warner Brothers Discovery, and the pledge that was made by Larry Ellison. Yep. So we talked about that. Guys, give us a follow there on social media. I definitely appreciate everybody that's already given the thumbs up out there on YouTube. That's always helpful. 127 people watching. Looks like 50 people have already clicked the like button. That's not only appreciated as sort of an applause to your presenter, but it also directly helps the webcast. It tells YouTube, hey, this was good. And then they promote that webcast or that video to more people. It helps more people find these discussions of things like trading weekly covered call options. All right, so thanks, guys. I will let you go. Go enjoy the rest of your day. I will see you in next week's webcast. I'll look for you in my other webcast series. I'll also look for you on social media. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.